IUL. Okay, Jeff. Ring ring.
Well,
Yeah, Jeff. This is Sean Simpson just getting back to you here for our scheduled appointment to go over the IUL with you. I'm running just a tad bit behind. Do you mind if I just jump right into it right now?
sure.
Okay. Let me ask you this. What got you interested in the IUL?
Well, I really don't know much about it, and maybe you could explain a little more, but I seen an ad on Facebook kind of talking about how I can grow my money tax free. Not sure if I'm believing that, but um,
Okay.
you
Kind
know,
of seen some ads on social media, that kind of thing.
yep.
Yeah, social media is kind of got my business, got me working 12-hour days sometimes. Let me tell you, there's a lot of people interested in this product. How much research have you really done though? Just looking around on social media, have you Googled anything? Have you found anything? What kind of information have you, do you know about the IUL?
I don't really know a lot about it. Haven't really had the time to research. I'm meaning to do it, just I'm real busy, so I haven't had the chance to really look into it.
Okay. Do you mind if I just kind of dive into it and explain it to you so that way you can kind of completely understand how it works?
Yeah, sure, that'd be great.
Okay. Sounds good. So first and foremost, I always like to tell my clients that it's a life insurance policy, not an investment. And I distinctly say that because I have some investor friends that call me up and say, "Hey, Sean, I want to invest in an IUL." Now, although there is some type of investment aspect of it, we want to keep it a life insurance policy, and that's what makes it tax free when you pull out money from it in the form of loans. Okay, are you familiar with a 401k, Jeff?
Yeah, actually I have one.
Oh, you do. Okay. Well, I'm going to compare it to a 401k. Not that there's anything wrong with a 401k. I just want to give you a little bit different perspective here. Okay. Um, the IUL also protects your family if you die, right? Because you could probably agree that, whether you're married or not, you have kids or not, your family and your people around you depend on portion of your income. And if you disappear off the face of this earth and exit stage left, that income is gone. And the income that you're going to make over the course of the next 10, 15, 20 years is helping your family. It's helping yourself. It's helping your community, right? And so it protects your family and uh, it protects your family if you disappear. So back to the 401k, let's say you've worked your tail end off over the course of, I don't know, 10 years and you got 100,000 in there, right? If you died, that's all they get is that 100,000, but they also get a tax bill, okay? Now, if they don't roll that over into their own 401k, if they're under 59 and a half and they go ahead and use that money, they also get penalized 10% from the IRS. So if they're in a 25% tax bracket and they get penalized 10%, now they're in a 35% tax bracket. And that's pretty big. I mean, if you have 100,000, 35% of 100,000 is about $35,000 that would go to the IRS, go to the federal government, right? So we want to try to stay away from that. Now, in the IUL, once you get approved, okay, and then you make that first payment, the next day you pass away, your beneficiary is going to get a substantial death benefit, even though you've only made one payment, and that is tax free. So it protects your family if you die. All the rest of these benefits that I'm going to go over with you are for you while you're still alive. Pretty cool, huh? That's why we call it life insurance, not death insurance. Another cool benefit for you is what we call living benefits. If you qualify for them, what they do is they protect you in case you have a loss of income. Let me ask you something here, Jeff. If you were to, let's say you weren't even working and you got in a bad car accident, but you didn't die. You got laid up in the hospital and you're in there for 4 months. Maybe you you can't walk. Maybe you can't bathe yourself. Okay, that's two of the daily six living activities. If you're laid up in the hospital for 4 months and you're not working, I'm sure your boss probably feels bad for you, but is he going to keep paying you if you're not working?
No, I mean, I'll have like about a month worth of PTO, but after that, I don't have any other income.
Okay. And maybe some people they do have, disability income, but that usually pays out about 60% of their wages, right? But guess what? Your IUL will pay you. Now, depending on the carrier that we qualify you for, they could either give you a monthly uh, paycheck, or they give you a large lump sum to help supplement a loss of income for a period of time. Okay. Now, when you heal up and go back to work, of course, they stop paying you. Of course, if you get sick, heart attack, stroke, kidney damage, liver damage, anything like that, cancer, Huntington's, ALS, something that's major like that, if something like that were to happen, you can pull from the death benefit while you're still alive. It comes from the death benefit, not the cash value. Okay. Now, the mechanics of it work like this. It's insurance, just like your health insurance, just like your car insurance. You pay into it, but it does have an investment aspect of it. So I like to say we contribute to it. So every month when you contribute to your policy, a portion of that goes to the cost of insurance. That's what gives you the death benefits, what gives you the living benefits. It's what protects you and your family, right? It's the protection side of your payment. The other portion of that contribution that you make goes to an accumulated cash value account. Now, that's just a fancy term for saying a savings account. Now, what do they do with that savings account? They index it with the market. It's not in the market, it's with the market. Okay. Indexing is very, very powerful, and I'll show you why. If you're in the market, just like a 401k, an IRA, stocks, bonds, mutual funds, they go up, but they also do what, Jeff?
We go down.
They go down, and they can go down below zero. And if they go down below zero, is that a happy day for you?
Oh no.
Oh, no, absolutely not. They also have the ability to give you a bill called taxes. We want to try to stay away from that while we're investing as much as possible, but we want to do it ethically and legally, right? Your IUL is different. It participates in the gains, it never participates in the losses. Okay. So, as an example, if the index goes up 12%, they credit you that 12% at the end of the year. If the index goes up 15%, as an example, the index will credit you 15% at the end of the year. If the market drops like it did in 2022, where I have clients that had 401ks, they lost anywhere from 15 to 20%. If the market drops, guess what? You flatline that year, but you don't lose any money. Everybody else lost money. You don't lose any money. You don't gain anything, but you don't lose anything. You just kind of flatline that year. Okay. And that is the most important thing, not to lose any money. Let me show you how important that is. Are you pretty good with numbers, Jeff?
I am.
Okay. I'm going to give you an example here that I use with all of my new clients. So follow along with me here. Let's say you have a 100,000 in your 401k. You have 100,000 in your IUL, and the market drops. We're just going to use easy numbers. 50%. How much do you have left in your 401k?
$50,000.
50,000.
Because
Yeah.
I'm really good with numbers. I was really good in school, and yeah, that's exactly what you'd have.
Yeah, 50,000. And that's not a happy day because you just lost half your portfolio, right? On the flip side of that, in IUL, if the market dropped 50%, how much do you have?
Again, I'm an expert with money, so you'd be at $100,000.
100,000. Okay. You don't lose any
Yes.
money, right? Okay. Here's the tricky part. The next year, the market goes right back up the same amount it went down. It goes up 50,000, or I'm sorry, 50%. Now, how much do you have in your 401k?
Well, Sean, third time, I'm an expert in money, so it goes up to $100,000 again.
Yeah, well, you may not be too much of an expert, Jeff. I hate to say this. Everybody says that, so don't feel bad, but that is not the correct answer. What is 50 of $50,000?
Oh, I'm sorry, my son was in here. He was distracting me. It's a 25,000, so 75,000. Yes, I do that actually.
75,000. Yep. So you dropped 50% down to 50,000. You went back up 50%. Now you're only at 75,000. But in an IUL, how much would you have if the market went back up 50%?
150,000.
150,000. Right. Now, all of this is all hypothetical, of course, but the market in this example, the market did exactly the same thing in both scenarios. It went down 50%, went back up 50%. But the most important thing is that only one product didn't lose any money. And because of that, you're now farther ahead. You know who Warren Buffett is, right? Everybody does.
Yeah, he's that big time investor dude.
He's one of the top investors of the world. Do you know what his top two rules of investing are?
Oh yeah, if, 2 weeks ago, if you would have asked me that, I would have told you, but I forgot.
Okay, that's all right. It's all over the internet. You can Google it if you want. But number one is never lose any money. Number two is always refer back to rule number one. Now, why would one of the top investors of the world put that as his top two most important rules of investing? Why? Because he knows that it takes twice as long to rebuild your money in a down market because you have to wait for markets to correct and you have to wait for the market to go back up after it corrects. And so if it takes twice as long, that may be a difference or a choice from, if you lose money at 55, now it may take 10 years to rebuild it. By that time you're retired, now you have a choice. That's a choice of, do I keep working or do I just take my money out of the 401k and retire? Or do we put it into a safer investment product that not only protects your family, it protects you, and it protects your retirement as well? Okay. So that's kind of how the IUL works. Obviously, we have to make sure that you qualify for it. Do you mind if I just take 5 minutes and ask you some finance questions, some medical questions to see if you would qualify?
Sure, sure,
Okay.
sure.
So Jeff, I got your birthday here as 7/9/1950 or 1968. Is that correct?
Uh, uh, okay.
I'm pretending you're older.
Okay.
Okay. So that puts you at what, 56?
Yes. Yeah.
Okay. And then what's your height and weight?
I am 5'3" and 220 pounds.
220 pounds. Okay. And then have you smoked any or used any tobacco products in the last year?
No.
Okay. How about in the last 5 years?
Yes. I smoked a couple cigars in the past.
Okay. And then are you married, single, divorced, widowed?
I am married.
Okay. What's your wife's name?
Patricia.
Trisha Bricks.
Yes.
Okay. And then what's her birthday?
Um, one of 1970.
1/19/1970.
Sure.
And then what's her height and weight?
She is 5 foot and 250 pounds.
Okay. Does she use any tobacco products?
No,
Okay. And now, are you looking into an IUL for yourself, for Trisha, or for both?
just right now for me,
Okay.
kind of looking into it.
All right. And then what are you more concerned about with your IUL? Are you wanting to build it for the death protection and the living benefits? Whereas that would be the higher priority where you get a little bit of cash value building on the side as well? Or are you focused on the flip side of that, meaning you want to build more cash value, but you want the smaller life insurance portion of it, which gives you a lower death benefit, lower living benefits, a lower cost of insurance, but build your cash value even more? Which one of those are you more focused on?
Well, I have a couple life insurance policies on myself already, so I'm not really concerned with that. So I like the idea of a cat of gaining cash value.
Okay, cash value. And what are you wanting to use that cash value for? For retirement, or are you looking to, you know, be able to use it for investing,
Yeah,
infinite
I
banking?
mean, for both, I think I like to have it for if to dig into for my retirement a little bit if I need it, but also for emergencies.
Okay, okay. Cool, cool, cool. Now, do you own your own home or do you rent?
I own
Okay. And then how long have you owned your own home?
15 years,
I see. Now, do you have a 30, 15, 20, or a 30-year mortgage?
30-year.
Okay, so you have 15 years on it left.
Correct.
Awesome. And then did you purchase that brand new, or the last time you got your mortgage, did you refinance, or how did you do that?
I got it brand new.
Okay. And then what is your mortgage balance?
Sean, why are you asking me these questions if you don't mind me asking?
That's a great question, Jeff. In fact, one of my clients asked, that's the same question that one of my clients that has an IUL asked me as well. And the reason why he asked me that was because these mortgage protection questions are, number one, we need to know financially where you're at. Number two, here's the most important part: if something were to happen to you, I'm sure you would want to have that mortgage uh, completely paid off so that there's no bill, right? I mean, if you're not working, how are you going to pay for the mortgage? Trisha would probably be able to pay that, but that might be a little bit of a burden to her, right?
Oh, actually, okay. Yeah, it's a good point. She doesn't work, so no, she wouldn't be able to pay it.
Okay, so you guys would be left out on the street if something happened to you. We don't want
Correct.
that to happen, do we? How much do you owe on your mortgage?
I owe 250K,
Okay, and then what's the house worth?
about 500K.
Okay. So by my math, you have about $250,000 of equity there. You definitely want that to go to your family if something happens to you, right? So it's a good thing that you're doing this. I commend you for doing this, Jeff, to protect your family. What is your monthly payment on your mortgage?
1,500.
Okay, and that includes escrow, meaning your principal, interest, taxes, and insurance.
Yes.
Okay, includes pity. Okay. Pity means principal, interest, taxes, and insurance. Okay. So what do you have to offset the cost of the mortgage when you die? Like, do you have any type of a life insurance product in place right now?
I do actually have two policies on myself. I
Okay,
have one for $600,000,
okay,
and then I have a smaller one for 150K.
and one for 150K. Okay.
Yeah,
Now, are
that's through
those
my
both
job.
policies?
Yeah, they're the 600,000 I own that one, the 150 is through my company.
Okay. So we're not going to count the one for the with the company, and I'll tell you why. It's a great policy, but it's kind of like a rental car, that the company gives you. If you quit, you get fired or you get laid off, you have to give the keys back to the company, right? So we don't count that. But regarding your $600,000 policy, is that a term or a whole life? I'm assuming it's a term since it's so large.
It's a term policy. I believe it was 25 years, and I've already had it for about 8 years.
Okay. And then, so it ends in about a little over 17 years. Who's
Sounds
that
about
with?
right. Transamerica.
Transamerica. Okay. And that one, I'm assuming, does not have any living benefits.
Honestly, I really don't know. I don't think so, 'cause I don't remember the guy telling me anything about it.
Yeah, most companies that have a term policy, most of them don't have any living benefits, and so I hate to say this, most of them don't pay out. Only 7 out of 100 of them pay out. And it's not saying they're a bad policy or the company's bad. It's not due to the carrier. It's just that most of the time people outlive that policy and they don't use it, right? Because it only pays if you die. You don't want to die. Nobody wants to die. It's there for protection if you do die, but what happens if you get laid up in the hospital again? Back to the other example, and you can't go to work. I mean, you're literally probably gonna, if you can't make your payment on your mortgage, you're probably gonna not make your payment on your life insurance policy, and due to that, then it's going to lapse and all that money you put into it is wasted. Even if you outlive the policy, all that money that you put into it is wasted. So would you be open to taking a look at a product that covers all of that as well?
Oh, yeah, absolutely.
Okay. And then you can actually choose to keep it or not keep it. It's totally up to you how you want to do that. Now, what do you have that acts as life insurance that would pay to a beneficiary if something were to happen to you, like a 401k, IRA, stocks, bonds, mutual funds, CDs?
I have a 401k through my company, and I have I think about $50,000 in it. I've been paying on it for about 10 years, paying into it.
Okay. And that's with your current company or with a previous company?
That's with my current company.
Okay. All right. And then any IRAs, stocks, bonds, mutual funds?
No, no.
Okay. What do you contribute to your savings account every single month?
Um, I we don't really put too much into it. Maybe 100 or two.
Every month?
Yeah, every month.
Okay. Say 150 on average, okay? And then today's Wednesday. If I were on any given Wednesday, if you were to look in there, how much is sitting in there
My bank account,
in your
probably like,
savings?
or my savings account,
Yeah,
probably, I don't know, probably like 4,000.
about 4,000. Okay. Okay. And then Jeff, what do you do for a living?
Oh, I'm like the director of engineering at a hospital.
Okay. And then what is your monthly net income take home?
I bring home about $20,000 a month.
20 a month. Okay. And then you mentioned your wife doesn't work. Is that correct?
That's correct.
Okay. And then if you were to, okay, monthly expenses, ballpark, if you were to add up your mortgage payment, car payment if you have one, gas, insurance, utilities, food, Netflix, any credit card payments that you have, if you were to add all of those up per month and ballpark it, what would you say it would be on average?
We just did this last night, so we have roughly about $5,000 of monthly expenses.
5,000?
Correct.
Is it okay if I just, most people underestimate, so can I just put in 6,000 just to be safe?
Sure,
Okay.
sure.
So by my calculation, that leaves about 14,000 extra per month. Does that sound about right or no?
Yeah, that sounds about right.
Okay, all right. Medical questions. What
Don't
prescription medications are you taking
don't
right now?
don't ask me how I only have $4,000 in my savings account. If I'm, but yeah, I'm not sure what I'm doing with my money.
Well, we're gonna figure that out here. What prescription medications are you taking?
I don't take any medication. My wife does.
Okay. Have you taken any medications in the last year that you don't take anymore?
Just for like colds, if I had like a cold or a flu.
Okay. All right. And then you said your wife takes medications. What does she take?
She takes blood pressure medicine.
Okay. And then let me run through these medical conditions here, see if any of these apply to you. Have you ever had a heart attack, stroke, mini stroke, cancer?
No,
Okay. Any stents ever put in?
no,
How about any diabetes or neuropathy, anything like that?
no,
Ever had any high blood pressure or lupus, rheumatoid arthritis, asthma, COPD?
nope,
Okay. How about any thyroid issues or anxiety or depression or kidney or liver disease?
no, nothing.
Nothing? Okay. Um, cool, cool, cool. Have you ever been hospitalized or had any surgeries in the last 5 years?
I had broken my leg back in 2020.
Do you have surgery on it?
Yeah,
Okay. Okay. Any other surgeries?
no,
Okay. Have you had a full recovery on your leg?
I have.
All right. Okay. How about any driving or moving violations in the last 5 years? Any speeding tickets or driving reckless, DUIs, that kind of thing?
No, sir. My driving record's pretty clean. I don't even really drive anywhere, so
Perfect. Perfect. Any felonies or misdemeanors in the last 10 years?
no, sir.
Okay. All right, Jeff. I think I have a lot of information here from you. Let's reschedule, and then at that point in time, I'll show you what a spreadsheet. We actually call it an illustration. And what that does is it'll show you based off of the current market values how much money you can have in retirement and when you can borrow from it, that kind of thing. But before we do that, I need to ask you for two numbers. Okay. Excuse me. What I want you to think about is how much you want to contribute to your tax-free retirement. Okay. So this is not like a term policy, Jeff, where you call me up and say, "Hey, Sean, I need $500,000. How much is that going to be?" And I tell you it's going to be $200 or $800, whatever it may be. But here, I want you get to decide what you want to do. Okay. Now, the rule of thumb is minimum you want to put in 10 times your age. But the cool part about it is, again, there's no cap. I have most of my clients put in $1,000 a month or 1,500. I have some clients that put in 2,500 a month. I have clients that put in 5,000 a month, 10,000 a month. It just really all depends on how fast you want your compound interest to compound and how fast you want to be able to borrow from it. Okay, so what I want you to think about here is two numbers. Okay, thinking about the whole year's worth of income, 11 months out of the year. Everything's going great. You're doing fantastic. All the bills are paid. What is the max that you would contribute to your tax-free retirement, knowing that you can borrow from it if you get into a pinch? On the flip side of that, 1 month out of the year where the repairs are a little bit high, maybe the wheels are falling off the car, what is the minimum you would want to contribute to your tax-free retirement no matter what?
So minimum $100 and maximum 300.
Okay, cool. Well, I got some information here. I'll put something together for you and then let's reschedule. Okay. And so, boom, timeout. At this point, I'm going to look at my schedule and put them back on the schedule. Now, I want to address a few things, and you probably already know where I'm going with this, right? You're 56 years old, right? And you want to put in $300 a month.
I knew
I'm not going
I
to,
did that on purpose.
I know you did. I'm glad you brought it up, though. It's great training. Now, uh, I'm not going to address it on this call, okay?
Okay.
Because right now you told me that's what you're comfortable with. Okay. Even though I know you have $14,000 extra per month that you can put into this thing. Okay. So I just told you the minimum you want to put in is 10 times your age, right? And so you still came out and told me $300 a month. So at the next call, I'm going to put everything together. I'm going to talk about an illustration. I'm going to share my screen with him, and then we're going to address this right at that point in time. Once it comes down to how much you want to contribute to it, then I'm going to show him, I'm going to say this. I'm going to say, okay, you know, I got here on my notes that you want to do max $300 a month. Is there any reason, or what is the reason why that's the max you would want to put into your tax-free retirement?
Well, I don't know. I guess I could put more into it, but I guess I'd have to see what it would look like.
Sure. And that's what we're going to show you here. The reason why I ask is because I wouldn't be doing my job if I wasn't concerned about your well-being. Because obviously you don't have anything for retirement, right? You have a 401k, but you have 50,000 in there. How long do you think you'd be able to live off of that when you turn 65?
Right, not very long.
Probably not very long. So we're kind of behind the eight ball here. And so the more you put into it, the faster it's going to compound. And I don't know if you're like me, but I know I want to live a better lifestyle in my senior years than I do right now. I want to travel more. I want to do extra things. And if I do those extra things, the economy is not going to be cheaper. With inflation going up, it's going to cost more, right? So if I want to travel, I got to have the money to do that. And so I would recommend putting in more. Um, Knowing that though, Jeff, how much do you think what's the max you would want to put in?
Well, depending on the numbers, like if you could show me like some figures, I don't know. I'd be willing to put in up to $1,000 a month to it if I feel like it's gonna get me some good money coming.
So now $2,000 a month. Okay. That's something that I can show you. And again, this is just an illustration. I'll draw it up for you. And if you want to adjust it down, we can do that. If you want to adjust it up and see what 3,000 is, I can show you that too. Okay.
All right, sounds good.
All right. And that's how I do it. Now, that's last part of it, guys. I want to make sure you guys are super clear. That last part of it was addressed on the third call, the second appointment where I run the illustration. I'm not going to talk about this low number on the same call as I'm qualifying him when I go through the financial inventory. And the reason why is because I don't want to scare him away, right? If he goes to sleep at night and he thinks, oh, he wants me to put $600 into this thing, but he doesn't understand why, then he's not gonna show up for the appointment, and then I didn't do my job and help the client, right? Because he needs to understand why. Well, a lot of times overnight, when people are dwelling on it and thinking about it and thinking about it, they talk themselves out of it, right? But they only have the information in their own head. His main source of information is coming from me. Right now, I'm the only guy that he knows of that has the most information about IULs. But I can't talk to him if he's going to no-show me, right? So we want to make sure that he has all of that information and he's comfortable with it. So I'm going to address the low amount on the third call, which would be the second appointment for the illustration and the application. And I'm going to wait to address it then. That way I can explain why and he can completely understand it. Okay. Does that make sense?
Yep.
Okay. All right.